If you're a small business owner looking for ways to save money on taxes, one of the tax strategies that I'm sure you've heard 1,000 times from everyone and your mom is you should switch over to an S Corp. And as a CPA, I get asked by people all the time, should I switch over to an S Corp to save money on taxes? What it mostly depends on, if your primary goal is simply to save money on taxes by switching over to the S Corp, is really what's your level of income in this business? Because in my opinion, if it's not at a certain level, then it's not really going to save you enough in taxes to make up for the additional cost that you're going to incur having switched over to the S Corp. But before we get to that, let's talk about what is being saved by switching over to an S Corp. So if you are a sole proprietor or a single member LLC considered a disregarded entity, you will file your business earnings and expenses on Schedule C on your personal tax return. What that means is all of your net income or your profit on the business will be subject to a tax called self-employment tax, which is just Social Security and Medicare tax. But it is a 15.3% tax on the first $160,200 and then 2.9% thereafter. So by switching over to the S Corporation, what we're looking to do is not completely eliminate this tax, but control it better and reduce how much we're paying. Because on an S Corporation, only the wages that are paid to the owner are going to be subject to that 15.3% tax, which will be otherwise known as FICA taxes, the Social Security and Medicare tax that is on your W-2 wages. That is the main idea, but it comes with a few caveats. So the best way to look at this is to put some numbers to this example. So let's say that you have a business and it earned $200,000 in total income during the year, and then you had $100,000 in expenses such as rent expense, supplies expense, materials, contractors, software, you name it. All those expenses were $100,000, leaving you with the net income or the profit of $100,000. That $100,000 of net income is what we're going to be focused on for this example. So on a Schedule C, all $100,000 or 92.35% of it, is going to be subject to that 15.3% tax. So just for some quick math, 100,000 times 92.35% is $92,350 times 15.3% tax is going to be about $14,000 in self-employment taxes. It's a pretty high tax. Now, let's say I have the same business, but on an S Corporation. Same total revenue of $200,000, same expenses of $100,000. I have $100,000 of business income. Now on an S Corp, as the business owner, you must pay yourself a fair and reasonable wage for the work that you're doing for this company. And typically, if it's a single member LLC, you're doing all or substantially all the work in this business anyways, so it's going to be a substantial salary. It's not going to be $10,000 or $20,000 on $100,000 of net income. So let's say that you find a fair and reasonable wage to be $60,000. Only that $60,000 will be subject to a 15.3% tax. The 7.65% would be paid by the employer, which is you, and the 7.65% would be paid by the employee, which is also you, which combines to be 15.3%. So 15.3% on $60,000 of a wage is about $9,000 in total FICA taxes paid, or self-employment tax, Social Security and Medicare tax together. So if I take $14,000 less than $9,000, that gives me about a $5,000 tax savings just by switching it over to the S Corporation. Now understand, my income still passes through to my personal tax return all the same from the S Corp. Because if I had $100,000 of net income, less the $60,000 in wages I paid myself, I'd have $40,000 in business earnings that are going to flow over. They're going to pass through from the business, because the business isn't going to pay taxes on it. I do, to my personal tax return. I'm going to have $60,000 of a W-2 on my personal tax return, and I'm going to have $40,000 of business income, $100,000. Whereas on the Schedule C, all $100,000 just passes through to the front of my tax return. I don't have a W-2 from that business. So the income is exactly the same. I just controlled how much of that 15.3% tax I had to pay. So if we were to stop right there, $5,000 in taxes saved, makes sense. Let's switch on over to the S Corporation. I could have even a little bit higher wage, still save money on FICA taxes. Let's do it. But before you do that, I want to give a little more context that doesn't always get thrown into the conversation because it's still kind of relatively new since 2018, but it is affected by switching over to the S Corporation. And that's something called QBI. Now, there are a lot of rules around QBI once you get to a certain level of income, and depending on the type of business you are you a specified service business or not? Some business owners will begin to phase out from being able to take this deduction. Some business owners will just have to change how it's calculated. we're not going to worry about any of those things. We're just going to look at it as its base level because of the level of income we're dealing with. Doesn't really require any of these other talking points. QBI is about a 20% deduction on the business income. So for simplicity, we're just going to use really simple round numbers to make this easy to follow. So on the Schedule C business, all $100,000 will get that QBI deduction. It'll get 20% times $100,000 or $20,000 in a QBI deduction, meaning it's going to reduce the taxable income that business owner has by $20,000. You know, kind of like the standard deduction reduces your taxable income. The QBI, same way, reduces your federal taxable income. So that's actually a pretty good QBI deduction. But the same owner, if he had switched over to the S Corporation, does not have $100,000 of business income. Because remember, part of his business income is now paid as a wage to himself, and that wage is not going to be included in this calculation for QBI. I now only have $40,000 of business income that's passed over to my personal tax return, which means I'm only going to get 20% times $40,000 for a $8,000 QBI deduction. That means I lost $12,000 in a reduction to my taxable income. So let's say in this scenario, you're in the 24% marginal tax bracket. Well, if you had a $12,000 increase in taxable income, right? Because that's the delta between $20,000 QBI deduction and an $8,000 QBI deduction, meaning it increases my taxable income by $12,000 in this scenario. That means federally, I'm going to pay about an additional $3,000 in taxes. So yes, while I did reduce my self-employment tax from $14,000 to about $9,000 and saved $5,000 in FICA taxes, I increased my income tax by about $3,000, meaning I've now only saved $2,000 in taxes. That's still pretty good. The last thing I'm going to emphasize is, great, so these are the tax savings that you have, $2,000. What additional costs are going to be incurred by switching over to the S Corporation? Because those are the other things to consider just from an overall monetary standpoint. So yes, you save money on taxes, but what else am I going to be paying for? You're now also going to have to pay for payroll, typically an increased cost in the tax return, and getting your books done a little bit more accurately because I now need a balance sheet in addition to my profit and loss statement so I can keep track of my equity, therefore my basis in my S Corporation, because that's another factor I have to consider, which is basis. A conversation for another time, but an important aspect of having an S Corporation rather than a Schedule C business. So, if those costs amount to over $2,000 additional dollars to switch over to the S Corp, then that means you are losing a little bit of money by having switched over to the S Corp. So in the end, is switching over to an S Corp going to save you money? Maybe. It depends on really where your level of income is, what your activity level is in your business, how much of a wage you have to pay yourself, and how much additional costs are going to be incurred by switching over. Consider all of those factors and talk about them with your accountant before deciding on whether it makes sense to switch over to the S Corp. So while I would recommend an S Corp for some, I'm not going to recommend it for everyone. And it's certainly not going to be, you should have an S Corp. It always depends. And that's how you should attack most tax strategies in your business. It depends. Thanks so much for watching. Be sure to like, subscribe, comment, and hit that notification bell. And be sure to follow me on TikTok and Instagram, where I post other short form content and where you can also tag me in videos that you see across the internet that you find to be a little suspect or would like my opinion on them. Again, thanks so much for watching. I look forward to seeing you all in the next video.